if the business was out there, we would have several hundred hedge fund Res, because there are the funds are out there, and given the extent of the investment funds industry here, we regularly get queries and of interest in funds getting into and getting exposure on the reinsurance side, but there just isn't that extent of sort of business out there. Financial reinsurance absolutely is another one. It's certainly in vogue now. It's sort of reinsurance that is more focused on financial management, really, as opposed to risk transfer. It is absolutely still reinsurance, but we're dealing ultimately with cedents that could potentially keep this risk on their balance sheet, but for other reasons, whether it's improvements for solvency ratios, whether it's credit enhancement, it might assist or with their credit rating for additional returns. They are interested in offloading or ceding risk to some offshore reinsurers. So that's certainly an area of growth. We see quite a lot of interest still in longevity swaps, not technically reinsurance, of course, but they are transactions designed to take a hedge. So, for example, a pension firm going to a large institution to hedge its exposure for longevity risks. Some of the main we have likes of Credit Suisse, SocGen, Deutsche would all provide those swaps. So not a lot of those, but they're very significant when they happen. Insurance-linked securities as well, in all of the forms that takes, is still happening in Cayman. There is some movement there. I think a slide or two will touch on it a little bit later. But I would say, Christian, that in terms of trends, I would say it is financial reinsurance. It's life and annuity. It's pension risk transfer out of the various categories of reinsurance we're seeing in Cayman. That would be, if I were to pick a trend, I would say that's obviously certainly what's in vogue at the moment.
So, Ryan, can we get your thoughts from a Cayman perspective?
Sure. I'm going to look at Cayman in a slightly different perspective from today. Yes, as we know, Cayman is the second largest captive domicile. But if you really look at the number of companies that we have and what they do, and they actually, most of them are doing reinsurance already, and these are reinsurance captives. So in a way that we have reinsurance. So reinsurance is nothing new to us. It comes in various levels of sophistication. What we are seeing the trend now is that the reinsurance captives are transforming into commercial reinsurance operations. For example, we have about 70 something class, what we call Class B, and majority of them are pure captives. Again, most of them do reinsurance, but we have about 130 where most of them reinsure third-party business, third-party risks. So we are seeing a growth in that segment. And then we have the ILS that Derek mentioned, essentially doing reinsurance between sophisticated parties. And then we have the likes of Re, who is operating with a Class D reinsurer. So this year especially has been a great year in terms of formations. We had some very large insurance groups relocating to Cayman, and a few large companies being formed as new reinsurance entries. Another kind of a development that at CIMA level what happened in this year is that our involvement at the IAIS, if you're familiar with that organization, that's the International Association of Insurance Supervisors. That's the standard setting body for all the regulators around the world, including the 50 states in the US. So they constantly look at the insurance core principles, ICPs, and they recently, about a year ago, they formed a task force to revise ICP 13, which is on reinsurance. and Cayman was selected. So we were involved at that level as well. So I think that gives us, take our interests to the table with the big reinsurance jurisdictions, and as well as learn from their thoughts and come back and learn and to revise or amend our standards. We haven't done it, but that's definitely we know how they think and where they're coming from.
Yeah. So Varun, I think most people in the room are probably familiar with what a Class D reinsurance company is, but for the people who aren't, would you mind just explaining what that is?
Yes, so we have 4 classes of license in the Cayman Islands, A, B, C. C is for ILS type transactions. Class D is meant for large-scale commercial reinsurers. And we have different capital requirements for them, and we expect such companies to have physical presence like Orion Re, the Green Light Re's, and have people here. So these are meant to be really large-scale, well-capitalized reinsurance operations.
Great. No, thank you. And we've obviously seen an uptick in the number of new sort of Class D operators that have come to Cayman over recent times. Why do you think these structures are deciding to come to Cayman as opposed to Bermuda, which historically has been the jurisdiction of choice for open market sort of commercial reinsurers? And let's, Derek, can we start with you for that? If you can get your view on that.
Sure.
On that question,
Yeah.
please.
Sure. So I think in the case of Orion Re, I think Karen, David's wife, told him to come to Cayman. So I think that is, but,
that is a true story, by the way.
But no, it's, I mean, that is really an interesting question, and the fact that some the Ds we have here. I mean, if you given the backdrop of some of the other industries, particularly investment funds that are here in Cayman. Orion's affiliation with Guggenheim, Greenlight Re's with Greenlight Capital. I mean, it shouldn't come as any surprise that they would choose Cayman. They already have a substantial interest and familiarity with the jurisdiction, so it is an easy fit. I think more recently as well, though, which has been interesting, there was a long period where we have this herd mentality where the reinsurers go to Bermuda and inversely, and Cayman is on the right side of the funds piece. Funds go to Cayman because why? That's the why, because funds go to Cayman and that sort of, and there wasn't actually anything very material to point to a distinction between the jurisdictions. So I think particularly with the adoption or Bermuda's obtaining Solvency II equivalency and all of the bells and whistles that go with that, that sort of absolutely generated quite a different distinction if you're a prospective startup looking at the two jurisdictions and whether it's crunching the numbers or it's looking at reporting or looking at the type of business that you plan to do and running the numbers. So Solvency II has been, the equivalency in Bermuda has been very important because, again, coming back to Cayman and the backdrop of Cayman, 90% of the business underwritten out of in Cayman is North American based. I think we saw some statistics recently, 1.7% I think of the risk underwritten here comes out of Europe. So a Solvency II approach, at least in my view, it's simply just not a match for the jurisdiction. So that's finally created some differentiating sort of factors that have really made a difference in prospects looking at Cayman. There's a couple. There's lots of other reasons. I mean, yeah.
So Ryan, can we just get your perspective? So obviously, it sounds like Solvency II is one of the key drivers in the fact that Cayman hasn't sought equivalence. What else do you think is helping to sort of bring this type of structure to the Cayman Islands?
Yeah, I think from a regulatory perspective, that's my area of. So I think our law allows different sophistication. We have a license category called B3, where a reinsurance startups, small, they are interested in the business, but they do not maybe have enough their own resources. So they like to be initially managed by a insurance manager and they have maybe limitation in their capital. So they can start small, and as they grow, their capital requirements will grow, and eventually they can transform into a Class D type of an operation. So the law allows that. So different entry requirements and at different levels. Another reason, as Derek mentioned, is that our industry here in Cayman is sophistication is nothing new. It's mainly because of the other financial services products available, banking, hedge funds. So it's our service providers, lawyers, attorneys, and other service providers, they are all very familiar with these structures. And sometimes when I attend regulatory meetings, and those who are not very familiar with the funds and funds-backed reinsurers, they're a little nervous because they think, oh, now we have to look at not only the liability side of the balance sheet, we have to look at the asset side of the balance sheet because the fund is behind. And we never had that nervousness because we kind of knew what the funds are. I think the other thing I'm looking from a regulatory perspective is the stability that the reinsurers are expecting. These are not like some captives where they are formed for a particular reason and exit is always there when they are formed. But reinsurers are more long-term in nature, so they require stability. They don't like laws being changed every now and then, government changing its policies every now and then. So I think that stability is there in the market, so that I see it as one factor contributing towards this.
Great. No, thank you. And David, obviously, to bring you into the conversation, apologies that I haven't asked any questions today, but so before, we're obviously going to get on to Orion Re very shortly in the background and the genesis and the strategy, but just to add on to the gentleman, anything from your perspective in terms of why Cayman? You know, obviously,
Sure.
Apart from Karen liking Cayman.
Right. I mean, Derek kind of already talked about the top two reasons. Karen said we were going to do it, and the fact that that Bermuda adopted Solvency II equivalency and Cayman has not. That's actually a very important factor. If you're focused on North American business, there's obviously no reason to be involved with Solvency II and all the additional reporting requirements and just level of complexity that would entail, and it just unnecessarily if you're not focused on European business. So that was a big factor, and the fact that Cayman has some flexibility in what accounting standard that you can use, as long as it was an internationally accepted accounting standard. So we had the choice of GAAP, IFRS, and we ultimately chose NAIC statutory accounting because that's the basis that all of our clients report on, and we thought it was important to be on the same basis as them. It's a very conservative solvency-based standard, and so we wanted to go with that. And then some of the more kind of practical reasons, we looked at things like the reputation and credit worthiness of Cayman versus Bermuda. Cayman, I think Moody's rates Cayman 2 full notches above Bermuda in terms of credit worthiness. We also looked at things like infrastructure. I mean, as you drive around Cayman, you see all the new roads, the new buildings. It's a very livable place. We work in Camana Bay, which is probably second to none in terms of a office location and all through the Caribbean. We also looked at the talent pool. With all the captives on island, there's a strong talent pool to choose from, so we don't have to bring all the positions from off island to fill those positions, because that's a very expensive proposition. So there's good employee base on the island, and you can get a lot of the skills you need right here in Cayman. And a couple more. The government's willingness to work, I think they're trying to attract new reinsurers. The fact that senior level executives can get a 25-year work permit is significant. You can't do that in Bermuda. And SEMA's been very easy to work with. And I'm not just saying this because I'm sitting here on the stage with Ruan, but they've been very accessible and responsive and fairly straightforward to deal with through the whole process. And lastly, I mean, just the livability of Cayman. It really is a fairly easy place to live, easy to own cars, easy to own property, some things that Bermuda's not necessarily known for.
Yeah. No, thank you. And I'm not sure how familiar everyone is with Solvency II, but Derek, is there any chance, could you just give like a 2-minute overview in terms of Solvency II and what that entails and why that is potentially onerous for someone who has US-focused business and it's not particularly relevant? We've obviously got the different pillars, but if you could give a quick summary in terms of the requirements behind it.
Well, ouch, yeah. Well,
Yeah, sorry, it's a bit of a curveball there, Derek, so sorry about that.
A very quick Solvency II, yeah, but being one of the main reasons I left Europe and came to Cayman. So, you know, the background to it, it's a risk-based model for regulation and supervision of insurers and reinsurers in Europe. It's entirely orientated around the risk profile of each particular insurer or reinsurer. So, so the previous Solvency I, let's call it, the previous framework, more of a one-size-fits-all. The Solvency II is obviously it's much more tailored. Some of the issues around Solvency I was that some of the member states were identifying some of the shortcomings of that pre-existing or the previous framework, and were tweaking their regulatory models, which of course is counter to what the EU is trying to achieve. So Solvency II was a push to harmonise regulatory and capital reporting requirements across the EU member states. As Christian said, there's the sort of the famous sort of 3 models of Solvency II. They're quantitative, qualitative reporting, so very, very complex. On the quantitative, it's how you're actually determining, identifying your risks and determining the capital that you need to maintain for the company. The qualitative is on corporate governance and reporting, it's on risk management. The third pillar being all of the reporting. That's a quick snapshot of something that took a decade at least to come into force. Many obstacles on the way. Corrective directives to be were required midway to address some hurdles that had not been pre-identified. But I suppose bringing it back to a Cayman perspective where the NIC model and risk-based capital versus a sort of a solvency capital requirements is the term used in Solvency II. Certainly, I said that life and annuity is quite in vogue now, but for under Solvency II rules, the risk weights to sort of long duration assets can be quite punitive. The capital you need to maintain is quite high, notwithstanding that you might quite well match in terms of duration, sort of assets and liabilities. So it's quite punitive. It would be, or at least my understanding, given the reinsurers coming in, the NAIC model and RBC is more, would be more favourable. I mean, it's probably one that maybe David to jump in on that, given he's the actuary. You can correct me.
No, I think that's correct. For us, NAIC risk-based capital is just a much more straightforward model, and more in line with what with what our clients do and where we need to be, as compared to Solvency II model, which is not straightforward and much more complex, but not necessarily by gaining that accuracy through the complexity.
So David, we've got a slide on Orium Re, but just for the benefit of everyone, can you just give an overview in terms of how Orium Re started, the strategy, and just some background behind the company, please?
Sure. So as mentioned, we're the third Class D reinsurer on the island. We were licensed in December 2016, and we focus on fixed and indexed annuities. And we felt that there was a growing need for additional annuity reinsurance capacity in the market. There had been some consolidations in the U.S., and so we felt there was a need there, and we feel like we have a compelling reinsurance solution that could help fill that space. So about 2 years ago, I was approached by a group of 3 shareholders who wanted to start a company. We did the analysis of Cayman versus Bermuda. The 3 shareholders are, they have significant U.S. insurance expertise and history. And just to touch on something you said earlier, there is some overlap in ownership with some minority ownership with Guggenheim, but we're not a related party. We're a standalone company not related to Guggenheim other than some minority shareholder overlap. But with their knowledge, and then we've built a staff here now of 8 people with significant reinsurance and insurance expertise. I think we have over 100 years of experience in our office. Collectively, yes, we are. But that, so that expertise allows us to develop personalized solutions for each client, very customized. And with a small group of shareholders, it allows us to have speed to close on deals. And so I think it gives us a lot of flexibility that some of the larger and certainly companies with more complex shareholder structures, it gives us the ability to move more quickly and be more agile. In this first year, we've closed two large deals, and I think by the end of this year, we'll have just under $3 billion of assets under management from those 2 deals. So we're not focused on doing a lot of deals. We look at doing a few deals, but very large deals, and customizing solutions for those customers.
Okay. And then Ruan, just moving on to you, and obviously we touched on, Class Ds, what they're all about. What sort of regulatory challenges do sort of commercial reinsurers? Obviously, we know that Cayman's known for its healthcare captives and more of the captive space. As we look to attract more of this type of business, what sort of challenges does that pose to CIMA?
Sure. As David mentioned, reinsurance usually involve large dollar value cross-border transactions. So we have to deal with regulators and insurers based in other jurisdictions. So the stakes are high. If something were to go wrong, there'll be other regulators looking at Cayman, and these are the companies that, if they fail, could definitely make big headlines, it could have catastrophic reputational damage. So that's an inherent risk. These are all inherent risks, so we have kind of controls in place. Another regulatory challenge we have as any regulator this is again a specialized area, technical transactions between sophisticated parties, so that the regulator need to have that sophistication to understand. Someone who's familiar with regulating a direct insurer cannot essentially regulate or supervise a reinsurance company, because slightly different, not slightly, very different. So we have that resource challenge. We have to find the right resource, and also we have to have dedicated, specialized people looking after such companies. The third challenge is, again, it has always been a challenge, but when you have, again, sophisticated companies coming into your jurisdiction, finding that right balance between flexibility and robust regulation. We need, as you know, Cayman always try its best to follow international standards. We are not ready to compromise on the international standards. At the same time, we need to we cannot just blindly adopt everything here. We need to customize it to suit our market here. So that's a fine balance between robustness and the flexibility. For, again, sophisticated clients, if the flexibility is not allowed, they cannot do transactions of this sophistication. So those are the, I would say, 3 main challenges we as regulators face with sophisticated reinsurance coming into the island.
So it sounds as if understanding of the business is important as well. And David, you probably if you touched on it earlier, but in terms of the communication that the Orion Re team have had with CIMA, it's been a very transparent and open process, hasn't it? We have regular meetings, we present our results, and anytime anything happens.
Right. I mean, we've set up quarterly meetings where we present our RBC calculations, present our earnings for the quarter. Each transaction that we do, we've submitted it ahead of time for approval, so they can review the structure of the deal and the terms before we finalize the deal. And then, after the fact, we've submitted the reinsurance treaties, the trust agreements, so forth, for them to review as well. So I think it's been a very open communication. Anything they've asked for, we've provided, and anything we've asked for, they've done a good job of getting back to us on a timely basis with their answer, whatever that may be.
Can we just go back slightly? You touched on the two transactions that closed to date in the first year. Can you just explain, what does a typical transaction look like? Obviously, I think a few people are familiar with Oriam Re, but
Sure.
If you can just provide a bit more detail.
So I'm not sure there's such thing as a typical transaction, but I'll just give some details kind of on what we look at and how we structure deals. So typically a deal is going to either be an in-force block of business that the client wants to reinsure, and they might want to do that to free up capital to utilize in some other line of business. Maybe they want to exit a line of business. Maybe they just need to reduce volatility there. Or there might be a new business deal where they're ceding each new policy they write, and they would do that to help with the financing of that business, or maybe they're trying to control the mix of business between annuities and life insurance to keep a balance between the two for their own ratings, to not get out of balance and have too much annuity business on their books. So those are kind of the two types of blocks that we would look at, in-force or new business. Within that, we look at structures. It could be co-insurance, which is where they would give us a percentage of all the premiums, the reserves. We'd pay a percentage of the claims, and the reserves would be on our books, and we would do the investing. Or they might do ModCo or funds withheld. In those cases, the reserves remain on the ceding company's balance sheet, although we would still be involved naming the investment advisor, and there would be a monthly settlement where interest credits and so forth get paid back and forth. But there's advantages and disadvantages of both between co-insurance and ModCo. One might free up more capital for them, have better RBC benefits for them, but on the other hand, co-insurance might deplete their balance sheet because the reserves move off of their balance sheet and onto ours, and they may have a reason they want to keep the reserves on their balance sheet. So we're flexible. We can do it either way, and the deals we've done so far have frankly been a combination of the two. So it's working with the client, trying to figure out exactly what their needs are, and then design that structure to maximize the benefits we can offer to them. I guess the only other thing I wanted to mention was, so we manage to a 400% RBC company action level ratio, and that's kind of equivalent to what an A-rated company in the U.S. would manage to. And so we're trying to keep our capital at a level that gives them comfort, because they're taking the credit risk for an offshore reinsurance company. I mean, we do put the reserves, the assets in trust and we're the grantor and they're the beneficiary of the trust, but still having that capital level of 400% company action level ratio gives them some additional comfort on our financial state.
Thank you. So Derek, Rowan obviously touched on some of the, not challenges necessarily, but some of the considerations with larger sort of commercial reinsurers coming to Ireland. Is there anything that you want to add in terms of what Cayman needs to look at in terms of being able to accommodate such types of business?
Sure. No, absolutely. And picking up on one point that that David mentioned, so the nature of the life reinsurance transactions, being on a co-insurance or funds withheld or a ModCo or a combination of those arrangements, it's by that very mechanic that we're doing these transactions out of Cayman, and that the cedent is in a position to get credit for the reinsurance. And without being in a position to get credit for the reinsurance, the offshore reinsurer is of very little, it's limited or no utility to that ceding company. So the nature of that structure is what's facilitating the growth in the market here. But to build on that would be for the jurisdiction to go and get NAIC equivalency. Yeah. So Rowan mentioned about internally from a regulatory and SEMA internal perspective having to get resourced up, get individuals in and everything that goes with that. But equally, from a statutory perspective in Cayman, the fact that we have one insurance law that's one size fits all, I mean, internationally that's inconsistent with how with how legislation is prepared in other jurisdictions, and even as I'm sure Ruan is aware, in insurance supervision groups and regulators, there's the guys who are doing life. I mean, they're not doing non-life. They're not doing reinsurance. I mean, they're all under an reinsurance umbrella, but they're very, very different, and it's a different skill set to actually pull the transactions together, to regulate them. But I think NAIC equivalency would be a huge feather in the cap for Cayman. It would certainly attract a lot of business. It's we on a couple of the committees that I'm on, there's some discussion on at a preliminary stage about how we might do it. But it's not that I think working initially from a perception that NAIC would not at all. I mean, NAIC would be very much in favour of that. It's creating new capacity. There's new reinsurers that there's been a lot of M&A in the States. There's been a lot of counterparts reinsurers that have disappeared. So creating that capacity is actually would be a benefit. And then the legislation to go with it would be separate, bifurcated, separate legislation for the reinsurers, separate legislation for captives. That's always and has been the foundation of the insurance industry here. It shouldn't be affected. I mean, I think that would be a development worth considering. And also, not to get in my soapbox, I always do about marketing in Cayman. I just think I was always on the legal and regulatory committee of IMAC. I'm now on the marketing committee. I think I think Cayman sometimes we don't make enough noise about our achievements and going out to win more business and sing from the rooftops would good old-fashioned marketing would help, I think, as well.
Okay. So a little bit off topic, but I'd just be interested. Year one as a CEO of Orion Re, sort of, David. Obviously, 1,000,001 decisions have been made. What's your first year been like as a sort of CEO, and how's it sort of surprised you? What have been some of the considerations and challenges?
Well, as an American, kind of the first challenge was learning to drive on the wrong side of the road when I got here. So that was the first. But seriously, 2 years ago when we started thinking about this, I started making a list of all the stuff we need to do to bring this to fruition and make this happen. And you start thinking of all the obvious ones. We have to get licensed with SEMA. We have to, where are we going to hire our employees from? Or where do we get the key employees? How are we going to generate business? And there's a lot of that it's just natural stuff that you think of and you have to do. But there was so many decisions when we got here that I hadn't thought of ahead of time. The first week in the office, you have to start thinking about what health plan do we choose for the employees, what pension plan, how do you structure vacation time, how do you open bank accounts? And that's probably been the most difficult part of this process, which was amazing to me. I'm used to, in the U.S., with $500 and a driver's license, you walk into a bank, and an hour later you walk out with a checking account. Here, it took multiple trips to the bank, trading just enormous amounts of information, almost equivalent to getting licensed as a reinsurer, I would say. And it was a very long and slow and not easy process. In the end, we have all the accounts and we have a great relationship with our bank, but that was a much more difficult process than I imagined. The other thing, I guess, just getting the right. It's important to find knowledgeable and good employees, but you also want to get an employee mix that get along and form a solid team. And I think that's been one of the things I've been most pleased with this first year is we've developed a really solid team, a lot of knowledge, but it's like a family. We got this office space that we made it very contemporary. People enjoy coming to work, and it's a fun place. I think people that work there probably are having the most fun. I mean, maybe I'm wrong, and if I am, don't tell me. But I think they're having the most fun going to work that they've had in any of their recent jobs.
Yeah, it's busy, but it's really good busy, just sort of being part of a startup. We've also got Diva Fish. We've got Stacey in the audience as well. We've got a beautiful aquarium in the office. And I had no idea, but we feed them mussels. And one of them had constipation, so basically had to go to the vet for a week for recovery time. So that's just something I'd never been part of before. But
He's recovered?
yeah, recovered well, and he's back in the tank and enjoying life. So
Little Metamucil in the food, and it's good to go.
So we've got 12 minutes left. We said to the committee that we'd cover insurance-linked securities. So we've got a couple of slides on ILS. So Derek, can we turn over to you, the sort of the wonderful world of ILS? If you can explain what it is, and if we've got maybe 5 minutes on ILS, and then we'll open it up to the audience for Q&A for the last 5 minutes.
Yeah. Sure. So ILS or insurance-linked securities is really just an umbrella term for transactions that are transferring risk to the capital markets. So when at the top of the talk we mentioned sort of hedge fund re, and that would be that really captures the convergence of the insurance industry and the hedge funds industry, and ILS would be convergence. It's insurance and it's capital markets. A lot of it is, if you consider, you've captives, you've reinsurers, you've retro providers. At some point in the risk chain, the reinsurer, there isn't another reinsurer to go to, so you have to get a little inventive. So it's when it comes to ILS in particular, there's numerous products that would come under the umbrella. There's catastrophe bonds and collateralized reinsurance and sidecars and transformers and everything. But again, at their very core, the purpose is to get insurance exposure to the capital markets, and there is an enormous demand for it. I mean, in terms of cat bonds, the markets or the total note issuance annually would be hovers around 12 to 15 million. CLOs are up at 120, or sorry, did I say million? It's 12 to 15 billion. CLOs is around 120 billion. There just isn't enough of these reinsurers of last resort creating these transactions, and the investors, they absolutely love these securities. It's something completely uncorrelated to the equity indices. I mean, you're really wondering whether the wind is going to blow or the ground is going to shake, and if it doesn't, you get your coupon every month, and you'll get your principal at the end. So the structures are it's insurance, but the structure has borrowed the features from structured finance and securitization. Maybe just go back to the one previous. So you can see
sorry.
there most issuances are 3 to 5 years. So the 3 to 5 year notes, issuance size is typically 50 to 500 million. For public deals, probably about 100 would be the minimum because of the cost to pull the transaction together. You can see the perils there: U.S. hurricane, earthquake, wind, Japquake, some alternative perils. So again, the global ILS industry is limited because there's limited perils, and there is a limited number of sponsors to do the deals. Just to,
Sure.
So your typical cat bond structure and catastrophe bonds are just one type of ILS transaction. But you can see there you have the issuer in the middle. That would be a Cayman Islands or Bermudan special purpose company. So it's also referred to, it's an off balance sheet entity. It's an orphan, variously referred to. So that's established. It's an orphan because its shares are held on trust. It's not on balance sheet to the likes of Swiss Re or Munich Re. It's off balance sheet. The issuer issues securities to the capital markets. It's a large public offering. There's a roadshow, very robust, large offering document. The proceeds from the note issuance come in. It's invested in collateral, which you'll see at the bottom, which is the piggy bank, which is generating returns, which make their way to the issuer, so that in return the issuer can make payments and satisfy its obligations on the notes that it's issued. And the purpose of it here is, you can see that the issuer here has entered into a reinsurance agreement with the sponsor. That would be Munich Re, Swiss Re, You know, in Europe, it's AXA Score. It's the insured, the state insurers of last resort. California Earthquake Authority do a lot of these deals. Those types of entities, and what they're reinsuring here is really the apocalyptic stuff. So it's you know, when Irma was supposed to go right up through the Florida Peninsula, I mean, there was guys were literally there was bottles of whiskey out, I'm sure, watching CNN, because that is the deal. If the storm hits and it hits certain triggers, which are very, very high, so there is a significant number of deals out there would have been on risk this hurricane season, but despite all of the damage done, there still would not have been triggers on the deals because they're set at such, the trigger is actually set so high. Some of them have been pulled, and the investors will lose. That's the deal. If the wind blows out in mid-Atlantic, you're fine. I mean, if it's going up through Florida, these guys are in trouble. And that's what's happening. Those major retro providers are creating a hedge for themselves via the capital markets for what are low frequency but very high severity events. So very interesting structures.
No, thank you for that. And I know sort of Cayman sort of dominated the cat bond market in years gone by. And I know, Ryan, you've been working with obviously government and your colleagues to sort of implement measures to improve sort of Cayman's competitiveness via the sort of Bermuda, for example. Would you mind just outlining some of the work that you've been doing with your team and government?
Sure. Now, these are, as Derek mentioned, again, created for a specific requirement, and there's capital markets and people waiting to invest. However, they don't want to just park their money and wait until the reinsurer or the reinsurer does all the paperwork and takes weeks or months for them to start earning. They want to quickly invest and start earning from day one. So this is a kind of a transaction where things need to happen very, very quick, especially the final phase of obtaining a license. So there's a commercial need for from the applicant's point of view to get the license as soon as possible. So we, having spoken to our board, and we convinced, our division was able to convince them to obtain the authority to license these within the division level, so which cut down the usual 3 to 4 weeks into 5 days. I think the last 4 transactions that we licensed, all were done, or turnaround time was less than 5 days.
Wow.
And also some of these transactions, depending on who the capital provider and who the insured or the reinsured is, sometimes they say, well, we don't need an audit for a particular year or for the entire term of the transaction. Our audit friends might not really like it, but if parties decide, they understand their risks, they get into the transaction knowingly the risks. Our procedures, our framework provides for them to come and request audit waivers. We won't grant them blanket audit waivers, but on a case-by-case basis, given their sophistication and the nature of the transaction and awareness.
It's fully collateralized.
Fully collateralized. Now, fully collateralized is good, but it's not no risk. It's a zero risk. There is some risk, so we have to try it. We have to have safeguards in place to cover the jurisdiction and stakeholders against those risks. But because it's fully collateralized and limited recourse languages, so it's solvency-wise, it's the risk is very, very minimum.
Great. So we've got 3 minutes for Q&A, and no one's left the room, which has been great. And I know we've got an hour until the beach party, so no one's looking forward to that. If you could just state your name and where you're from, and if you can ask which panelist you're going to direct your question to, that'd be great.
Sure.
Thank you.
My name is Karan Shah. I'm from Reinsurance Company out of Florida. Thank you very much for all of your time. This question is, do I need to repeat everything that I just said?
No. We heard you loud and clear. That's fine.
All right, terrific. This question is to Derek about the cat bonds. I'm not 100% familiar with them, so I appreciate the background.
Sure.
Now, with the collateral, is is there any benefit where if an entity, the sponsor, has access to a revolver and the cost comparison between, having the collateral versus just tapping into the revolver, would that kind of nullify the cat bond concept? And
Yeah, I mean, interesting question, and just, I suppose, a little background. I mean, back pre-2008, the if you want to go to the collateral or the piggy bank backing the deal that I mentioned, that was actually quite, that's where there was some fun being had. It was a very, it was imaginative. There was lots of sort of total return swaps, and there was various assets in there, and they were quite aggressive in terms of assets in generating returns, so that the issuer could make the payments. Now it's gotten very, very vanilla, to the point actually that generally the collateral now in a cat bond will not generate sufficient return, and part of the risk transfer contract is that the sponsor is actually there's a top up there. So you could, and to your question, you could get imaginative, but it's really not market now. It would be off market to get creative like that. The investors have a number of deals that come out that they pick and choose from, and features like that probably from a legal perspective could probably work in terms of collateral, but from a marketing perspective it might be tough to move the notes.
all right, thank you.
So Paul, do we have time for any more questions, or one more question? Okay, thank you. James, yeah.
Yeah. Okay, this is David, and even you, Christian. You mentioned the trust that's used as collateral for the cedent. Is that money coming from third-party investors or yourselves?
No, the money in the trust,
For the non-premium end
the
of it?
over-collateralization would be from the investors. The initial money in the trust would be the reserves. If it's an enforced deal,
Yeah,
the reserves transferred to us would go directly in a trust, and then we would over-collateralize that by, some percentage, and that over-collateralization would be money from the investors.
Okay, so it's almost like it's like a variance of a Class C insurer, but this is for the life and annuity business.
Yeah, the assuming assets will offset the liabilities,
Yeah.
and then, as David said, you over-collateralise in accordance with the reinsurance treaty.
Yeah.
Yeah.